Welcome to the Black Wealth Creator Podcast, where we help uplift the Black community through financial education. Welcome back to the podcast. On today's episode, I want to talk about mutual funds. So what are mutual funds and what benefit do they bring? A mutual fund is a type of financial vehicle made up of a pool of money collected from many investors to invest in securities like stocks, bonds, money market instruments, and other assets. Mutual funds are operated by professional money managers who allocate the fund's assets and attempt to produce capital gains or income for the fund's investors. A mutual fund's portfolio is structured and maintained to match the investment's objectives stated in its prospectus. What? So pretty much a mutual fund is a lot of investors putting their money together and buying stocks or bonds or other securities in order to produce a profit. And when you invest or when you buy a mutual fund, you are part of that pool of money. And this particular mutual fund that you purchase is managed and run by money market money managers who, of course, they know the market, they understand what's going on, the ins and outs of it, and they make wise financial decisions towards, okay, we should invest in these particular stocks, we should invest in these particular bonds. And normally, if it's a particular segment, then it'll be within that segment. So if you got like a technology mutual fund, it'll be geared towards, let's say you got like an aggressive technology mutual fund, it'll be geared towards aggressive stocks, meaning that stocks are just like super risky, but they may produce like high profits if it hits. So you invest in, like, it's a aggressive technology based thing. So you look for brand new technologies that have the potential to blow up and become the next Apple or the next Google. Or I wouldn't even say that big, but just something that maybe Apple or Google might purchase in the future, like an Instagram or something like that. So that's all it is. You're pretty much putting your money, when you buy a mutual fund, you're pretty much giving that fund your money. You're helping fund the project. You're giving them their money, and you're trusting those money managers to like pick good stocks. And they normally do things that are going to be kind of like opposite. So it may be technology. So maybe one part of your technology is in if the world stops, like in electrical cars or something like that. Maybe they're like this new electrical type of company coming out. They might buy heavy stocks in that, but they might offset that by purchasing like fossil fuel, like raw commodity type things, just to offset that. So in case the economy goes crazy and let's say we stop using oil altogether, the fossil fuel might go down, but this electrical car company might go up really high, and so you offset. Or if that electrical car company just crashes because it stocks, then you and then the oil thing, it goes up, so you're kind of still balanced in terms of you aren't just out of all your money. And so there's just a general growth rate to that mutual fund. So that's all like a mutual fund is, just a collection of money with a whole lot of investors, and they allow these money managers to properly allocate their money to gain a profit, of course, but properly allocate all that money to the particular stocks and bonds that are tied to it. So why would we utilize a mutual fund versus a stock? So one thing to remember with the mutual fund, there's a lot of other investors. So there's also it's just less risky. Like, it's all about risk. At the end of the day, it's all about the risk. You've heard, don't put all your eggs in one basket. When you buy stock, you essentially put all your eggs in that one basket. Like if I buy, I don't know, $1,000 worth of Google, well, you couldn't afford Google stocks at $1,000. If I buy $1,000 worth of Ford Motor stocks, if I buy $1,000 worth of Ford Motor stocks and Ford Motor goes out of business, I just lost $1,000. Whereas if I buy $1,000 or I contribute $1,000 to a mutual fund, then Ford Motor may go out of business, but there's a whole lot of other funds within, there's a whole lot of other stocks and bonds within that particular mutual fund that you could utilize, and that not utilize, but that is utilized in order to generate profit for that mutual fund. So you still might make of course you're gonna keep your $1,000, but it might even grow even if Ford goes under. So that's just one of the benefits of using a mutual fund. On the flip side, when it comes to stocks are you buying ownership in a company. So that means, like, when I put that $1,000 in there, I'm getting $1,000 worth of ownership. So that means if there's any stakeholder votes or anything like that, in order to, like, let's say they want to go up on a dividend or go down on the dividend or whatever, they'll put that out to a vote for all the people who own stocks within that company, and they'd essentially vote on it, and you've had to vote. I've gotten emails from people who I hold stock in their company, and they, like, hey, vote on this issue or vote on this matter or whatever. So you can definitely do that. When it comes to mutual funds, you do not have that luxury. You essentially, you just, whatever that mutual fund, whatever they want to do, that's what they do. Like, you just along for the ride. So that's just one of the disadvantages of having a mutual fund. So when would you do one or the other? If you're looking for, like, impact in a company, go the stock route. And if you're looking to, like, build your own portfolio, go the stock route. Well, I just want $1,000 over here, $2,000 over there, $3,000 over there. I just want to see it all grow. I want to be in this, you know what I'm saying? Like, you get to choose which industry you want to be in or which company you want to help boost or whatever. But whereas if you're looking more towards, I just want to build wealth in terms of, like, not that you could build wealth with the stock, of course, but if you just want, like, almost like a hands-off approach where I just pay this person and they help build my wealth, I give them the $1,000, they might charge me a fee, so my 1,000 may be, I don't know, 900, 950. But they're gonna handle doing the market research. They're gonna make sure that everything's on the up and up with those stock purchases. They're gonna make sure I'm getting the best bang for my buck. So they're gonna sell when it needs to sell. They're gonna buy when they need to buy. They're gonna do all those things. So that's the benefit of joining that's the benefit of having a mutual fund versus a stock. But also you get, like I said, there's also the benefit of having a stock. So pretty much that's when you would utilize one or the other. Like, when you use a stock when you want to build your own portfolio or just have general ownership, you're using mutual fund when you're just trying to do, like, general wealth building and growth. Now, me personally, I would recommend you do everything. Like, you get some individual stocks, you get some ETFs, you get some mutual funds, you get some of everything that you can. Diversify your portfolio as best you can, like, because it's all growth. It's all going to grow. Everything's in the market's going to grow. Now, like I said, there's a little bit more risk tied towards stocks, but if you invest in established companies like a Ford or a GMC or McDonald's or stuff like that, companies that's been around forever, like, you're still going to be growing at a pretty decent growth rate. So I wouldn't worry about, oh man, I'm gonna lose all my money. Don't be afraid of that. You're not gonna lose all your money. Like, you're gonna be able to find. And then even if it just, you pay attention as well, like, pay attention to the market. Like, okay, McDonald's is going bankrupt, so okay, yeah, let me run and sell what I can and salvage whatever money I can. So, but I just want to do a quick lesson on mutual funds. If you ever hear that term, just, you have a little bit general understanding of what that is. And pretty much, just to recap, a mutual fund is just a pool of people putting their money, So a mutual fund is just a group of people pooling their money together to buy certain stock or to allow money managers to buy certain stocks and bonds and other securities to generate a profit for that overall portfolio. And you're pretty much, whenever you're investing in that, you're just investing in that portfolio, trying to be a part of that growth. So that's all it is. I hope you gained something from the video. And yeah, I hope you gained something from the video. please remember, like, comment, like, subscribe, tell your friend about it, tell your cousin about it, tell your auntie about it, like tell somebody about the podcast. I really think it's some good information that can help someone. So please like, comment, share, and subscribe. And yeah, y'all be good. This has been another episode of the Black Wealth Creator Podcast, where we help uplift the Black community through financial education. Remember, getting money is easy, but building wealth takes time and effort. Anybody can do it, especially you. Be blessed. Be blessed, my brother. Be blessed, my sister. Be blessed wherever this life leads you.